For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Today we will explore a scenario where certain analysts with a pessimistic outlook suggest that Palantir Technologies' stock price could potentially decline to $40 per share. By understanding both the risks and opportunities associated with Palantir stock, investors can better assess whether it aligns with their portfolio strategy. To begin, let's consider a hypothetical situation. Imagine you are a shareholder of Palantir Technologies, and over the next several months, the stock price plummets by 50% or even more. Such a decline might seem shocking, but history has shown that it is not an impossible scenario. Looking at the stock's performance in recent months, we see a pattern of significant volatility. At the start of the year, Palantir experienced a remarkable surge, rising by over 60% from early January and surpassing $120 per share by the middle of February. However, that upward momentum was short-lived, as the stock later declined by approximately 38% from its peak, bringing it down to around $80 per share. This sharp reversal has raised concerns among investors, leading many to question whether the stock is on a downward trajectory that could push it even lower. One of the key drivers behind Palantir's stock rally earlier this year was the growing enthusiasm for generative artificial intelligence. The company has positioned itself as a leader in AI-driven data analytics, benefiting from the broader trend of AI adoption across multiple industries. Additionally, political factors have played a role in influencing market sentiment, with Donald Trump's re-election as President of the United States being seen as a favorable development for defense and intelligence-related companies like Palantir. Furthermore, the company has reported strong earnings in recent quarters, reinforcing investor confidence in its long-term growth prospects. Despite these positive factors, recent macroeconomic developments have triggered a broader market sell-off, leading to increased uncertainty for high-growth stocks such as Palantir. One major concern stems from the possibility of a U.S. recession, fueled by President Trump's decision to impose tariffs on key trading partners. Historically, heightened trade tensions have led to economic slowdowns, which in turn have negatively impacted the stock market. Given its elevated valuation, Palantir's stock could be particularly vulnerable to a sharp correction in the event of an economic downturn. Examining historical data provides further insight into how Palantir might perform under adverse conditions. In 2022, for example, the stock suffered a significant decline, losing over 70% of its value in just a few quarters. This serves as a stark reminder that even high-growth technology companies are not immune to market downturns. At present, the stock has already dropped from $120 to $80 within a matter of weeks. It is important to recognize that individual stocks tend to exhibit greater volatility compared to diversified portfolios. For investors seeking long-term growth with lower levels of risk, diversification may be a prudent strategy. By spreading investments across multiple high-quality stocks, investors can mitigate some of the risks associated with holding a single, highly volatile stock like Palantir. Another key aspect to consider is Palantir's revenue composition. In 2024, approximately 55% of the company's revenue came from government contracts. While government contracts can provide stable revenue streams, they are often unpredictable and subject to shifts in policy and budgetary decisions. This makes them less reliable as a long-term growth driver compared to commercial contracts. Additionally, the new Trump administration has been focused on easing geopolitical tensions through diplomatic efforts, including mediating between Ukraine and Russia and addressing the Israel-Palestine conflict. While such actions contribute to global stability, they could also reduce the demand for Palantir's software and services. The company has historically benefited from geopolitical uncertainty, as its analytics platforms are widely used by government agencies for intelligence and defense purposes. If geopolitical tensions ease, Palantir's government-related business segment could face slower growth. Looking beyond government contracts, Palantir's long-term expansion strategy is centered around growing its commercial business. The company's Foundry platform is designed to serve industries such as manufacturing, retail, and healthcare, providing data-driven insights to help businesses optimize their operations. In the most recent quarter, commercial sales in the United States grew by 64%, significantly outpacing the 45% increase in government-related sales. This indicates that Palantir is making meaningful progress in diversifying its revenue streams. One of the primary obstacles to scaling Palantir's commercial business is the complexity and cost of implementation. Unlike traditional software solutions that can be easily adopted by businesses of all sizes, Palantir's products often require extensive customization and integration, making them more suitable for large enterprises rather than small and medium-sized businesses. This limitation could constrain the company's ability to expand its customer base in the long run. Profit margins have also been a focal point for investors. Over the past few years, Palantir has successfully increased its margins, with operating margins rising from approximately 26% in 2023 to nearly 35% in 2024. This improvement has been driven by the company's ability to control marketing expenses while maintaining strong customer relationships. Palantir's approach of working closely with clients to tailor its software solutions has contributed to customer retention and reduced the need for extensive sales efforts. However, if the company decides to pursue a more aggressive expansion strategy to attract a broader range of customers, its costs could rise, potentially putting pressure on margins. Furthermore, competition in the data analytics and artificial intelligence sector is intensifying. Large technology companies such as Microsoft have the advantage of extensive enterprise relationships, allowing them to cross-sell AI-driven solutions to existing customers. This competitive dynamic could limit Palantir's pricing power and impact its long-term profitability. Palantir stock has historically been more sensitive to market downturns than the Standard & Poor's 500 index. While investors are optimistic about a controlled economic slowdown, it is important to consider how severe conditions could become if another recession occurs. Despite these risks, the stock market tends to focus on short-term trends and often extrapolates them into long-term expectations. In Palantir's case, investors remain optimistic about the continued expansion of artificial intelligence, with the company expected to grow its commercial business while reducing its reliance on government contracts. However, challenges such as economic uncertainty, competition, and valuation concerns cannot be overlooked. Palantir's revenue has grown significantly in recent years, increasing at an average rate of 23% over the past 3 years, compared to a 6.9% rise for the Standard & Poor's 500 index. However, the stock is currently trading at a lofty valuation, approximately 48 times consensus revenue estimates and around 140 times projected earnings for the same period. Historically, high multiple growth stocks have struggled during economic downturns, as slowing earnings growth leads to significant declines in valuation multiples. Additionally, during periods of heightened risk aversion, investors tend to shift their focus toward more defensive sectors. Given these factors, it's crucial to ask yourself, will you continue to hold shares of Palantir Technologies, or will you sell if the stock price drops to $50, $40, or even lower? Holding onto a declining stock can be a difficult decision, and understanding the risks involved is essential for making informed investment choices. Palantir Technologies has experienced significant volatility, with its stock surging over 60% early in the year before falling from $120 to around $80 per share. While excitement over artificial intelligence, strong earnings, and government contracts have fueled its growth, concerns over a potential US recession, market sell-offs, and geopolitical stability under the Trump administration pose risks. Historically, Palantir has seen steep declines, including a 70% drop in 2022, raising the possibility that its stock could fall further, potentially reaching $40 per share. While the company is expanding its commercial business, challenges such as high implementation costs, competition from tech giants like Microsoft, and uncertain margins remain. Given Palantir's high valuation, trading at 48 times projected revenue, investors must assess whether they will hold their shares if the stock continues to decline or to shift toward more defensive investments. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.